There folks, welcome into today's video. 3 to react to in today's video. First one is markets are closer to the end of the valuation recession. This is very important, and we've got to talk about what that means essentially, why that matters for the stock market in general, why that matters for stocks, okay? Then I want to react to this one here. Economic slowdown will force automakers to end price hikes, says the former Ford CEO. And so I want to watch that because obviously the auto market's been out of control. I think everybody knows that, who pays attention to autos over the past 1 to 2 years. It's been ridiculous. Like, people have been basically getting a car and then driving it for a year or two and then selling it for profit. Like, stuff that should never happen. Weird stuff's been happening in the auto market. This matters, obviously. A lot of Tesla shareholders follow my content. So we got to talk about what all this means for the overall auto market, if this is something that can hit Tesla or not. We'll discuss that in this video as well, okay? And then this one I want to react to, which is essentially, AMD reported earnings. I think some of you guys might have heard that. I want to react to this gentleman's opinion on what his opinion was on those earnings and then share my opinion on those AMD earnings. So yeah, 3 videos to react to. They're all going to be good ones. Hope you guys enjoy this as always. I love doing this channel, and my gosh, I guess you guys love it too. I was checking out Social Plate earlier, and it's like every day 100 subscribers. I think right now we're at like 18,100 subscribers or something like that, or maybe even higher than that. So I appreciate each and every one of you that subscribe to the channel. I'm glad you guys are enjoying this reaction channel. Also, if you ever want to say hello to me, say hello on Instagram, Financial Education Jeremy. You can always say hello to me and send me a DM on there. All right, guys, let's go ahead and get into this.
Joe Terranova. Joe, also, of course, a CNBC contributor. Joe, this has been a pretty persistent theme. Today we see Amazon down 5%, Alphabet 4%, Apple and Microsoft off 1.5%. Sometimes you point to yield, sometimes you point to what the Fed's going to do. This seems more just like a liquidation in that style and size of stock. The average stock actually doing okay today. Equal weighted S&P up a little bit. How do we read it? Is it just kind of the tail end of the process we've been in for a while, or is there a new reason to worry about what it means for the indexes?
Well, I think 2 things. First of all, I think it is strategic to your point. But second of all, we have been in a valuation recession since Q4 of 2020. It's rolled through different equity size classes. It's rolled through different strategies and through different sectors. It's now touching the last place where that pristine valuation, that premium, was maintained, and that's in the mega caps. That's comforting from the aspect of it means we're closer to the end of this valuation recession, but you still have to wonder what's the overall impact on the market. How much longer can the indexes keep the resiliency that they've had the last several days if the selling pressure in mega caps continue?
For sure. And
so the reason this is very important, when you hear him talking about valuation recession, another way of putting that is valuation correction, okay? So in the stock market right now, and this is important to understand because this is what a lot of folks have feared, even the Ray Dalio type folks, okay, is first we were going to get a valuation hit where stocks are going to readjust because maybe some stocks got overvalued. And I don't think you could say that blanket statement on every single stock's overvalued. Absolutely not. But were there definitely some stocks that were massively overvalued going into, obviously, 2021? Yes, absolutely. So we've had a massive valuation correction where countless stocks have fallen 40, 50, 60, 70, some 80, some 90% at this point in time, okay? So that was the first part to play out. Now, the second part, which is a debated part, and this is important, is do we get a major recession in the economy, a major, massive earnings recession? We've already started to see a little bit of an earnings recession for these companies, right? But do we get a much bigger version of that in 2023? That's the fear, and that's what's still out there. That's still to be debated. The valuation correction, that's already happened now at this point in time. So if you're thinking about the next big move, like if we were to get the stock market, let's say, go much lower, and let's say the NASDAQ right now is down 33%, let's say roughly, it's probably somewhere around there. How do we get the NASDAQ down 50%? Massive earnings recession where companies' earnings tank in 2023. That's how you get the NASDAQ down 50% or more. And if that happens, we're going down there, right? But if we don't, and these companies kind of skate through, kind of like they've done, where they're just like, some companies are pretty good earnings, some are decent, some are okay, a few are bad, but it's not enough to push the whole market down, then you can kind of skate through the whole situation. I do have some fears about, obviously, I've mentioned many times, I don't want to keep beating a dead horse there. I do have some worries about Apple in 2023. Let's go ahead and jump back into this.
I wonder what you think is now implicitly in the market when it comes to what the Fed's going to do, how much that actually is the decisive swing factor from here on out? Are we again setting ourselves up for one of these hope-based rallies where it looks like resilience until you run into a central bank that doesn't want to see the market being resilient?
Well, I do think that what is priced in is the unprecedented 75 basis point hikes. We've priced in that the Federal Reserve is going to take that tool and put it back in the toolbox. The expectation clearly is that we'll begin to see a change in the interest rate hikes. We'll see 50 basis points in December or something along those lines. So that, without question, to me, is priced into the market.
Yeah. But do you think
something I am personally worried about? Hold on. Let me have him do this part, and then they'll share something important that I'm really worried about.
Need to hear something explicit about, look, we have the destination in sight in terms of what the target Fed funds rate is going to be in a few months. Give the market some sense of we're nearing the end of this process, or do you feel like a step down to 50 basis points is enough?
I think it's really...
Before he gets into basis points, I'll share my opinion here. So the thing I'm worried about for especially 2023 is the Dow. The Dow stocks have not gotten hurt the way you would think should have gotten hurt, right? But a lot of those companies are what I call big lead time companies and laggers, okay? Whereas NASDAQ stocks, many of them feel like the contraction right away. Like it's almost immediate. Whereas a lot of these other companies, the Caterpillars of the world, the McDonald's, and a lot of those stocks have been like a flight to safety. So let's hide out in those. Let's move our money there. But also a lot of them have held up well. And if you're thinking about where could real weakness be in the market potentially, I'm actually not as scared about the NASDAQ and those sorts of stocks because those have already been wrecked and buried, right? Doesn't mean they can't go down more, but they have been, right? And so in 2023, what I'm actually really concerned with is the Dow. And a lot of those S&P stocks that have held up really well this year because they've kind of had like freak situations happening that's helped them, including like energy stocks and things like that. And what that could do for the indexes in terms of potential damage there. So, in terms of Russell, in terms of NASDAQ, obviously those could always go down more, but I'm not as concerned about those in 2023. It's much more the Dow and the S&P to a certain extent, right? And do keep in mind in regards to S&P, what is the biggest weighted stock? It is Apple stock. So obviously, if that one does fall, of course, it's going to pull down the NASDAQ, but it'll also pull down the S&P 500 big as well. And obviously, Apple's in the Dow 30 as well, so it would pull that down big as well. If that's a big if there was real weakness in Apple, obviously, in 2023.
Offering the market a chance to catch its breath. Mm-hmm. And it seems as though the Federal Reserve, because they're playing catch up, Mike, it's making the market run. It's almost as if the market's enduring a stress test and it's on the treadmill, and the Federal Reserve keeps turning it up higher and higher and making the market run faster and faster. I think all the market really needs is a sense of let's take a break, let's catch our breath. And ultimately, I think why you will get that is the Federal Reserve is going to look towards the shape of the yield curve. They're going to look at that recession 3-month to 10-year part of the curve. And we've had sustained inversion now for multiple days. We haven't witnessed that so far during this process. We've had brief inversions for maybe a couple of hours, but now it's sustained. There has to be an acknowledgement on the part of the Federal Reserve. To your point, we're closer to the end.
It's again toggling right around that zero line between the 3-month and the 10-year, depending on when you look at it. But the other people pointing out, Powell has mentioned the 3-month versus 18-month. In other words, any structure of bond yields and bill yields that say, look, the market thinks you're in danger of over-tightening. The next major direction of policy moves is lower in response to weakness in the economy. Have we given up the idea that the landing can be softish at this point, or is it still there? The earnings don't necessarily tell you to run for the hills yet.
Well, it depends what you're looking at. If you're looking at the economy, the jury is still out on a soft or a hard landing. If you're looking at risk assets, without question, we had a hard landing already, and in particular for a variety of different strategies. So does the Federal Reserve, is that their care? Is that the concern? I don't think so. And I think the Federal Reserve is going to walk a very difficult line here in the coming days where they don't want to create elevated volatility once again to where you have to say to yourself, okay, is there stress in the system? But but they also don't want to see the market get too far ahead of itself.
Yeah,
that is
he put that perfectly. He put that perfectly, honestly. Okay, if you missed that or didn't kind of catch that there, what he basically explained there is that Jerome Powell, personally, the Fed, Jerome Powell, he has to walk this tightrope because he doesn't want to create a massive volatility situation where the whole stock market tanks, right? He doesn't want to create that type of fear out there, and obviously the market's already gotten hit enough, so he doesn't want to do that. But at the same time, he doesn't really want the stock market to go up right now. He doesn't really want the financial markets in general to feel good. So it's a funny place where he doesn't want it to feel like it's the end of the world, like a great financial crisis, but at the same time, he doesn't want things to go up right now. So it's a very weird dynamic for the Fed, and a very, like you said, like it's like a tightrope Jerome Powell's basically walking here. And we're going to see obviously how it plays out, but it's, I wouldn't want that job. That's all I'll say about that. I wouldn't want that job, man. I focus on picking stocks and investing in companies. I don't want his job. That's all I'll say about that, man. Alrighty, next video up here. Economic slowdown will force automakers to end price hikes, says the former Ford CEO. Alrighty.
Is 10.3%. That's up from 9% in March. New vehicles come in at 6.3%. That's up from 5.2% in March. Our next guest expects auto dealers to hold the line on prices, at least for now. Mark Fields is a former CEO of Ford and Hertz. He's now a CNBC contributor. Mark, great to see you again.
Hi, Melissa.
How much pressure are these dealers facing at this point with the cost of owning a car per month just skyrocketing here?
Well, you're still seeing a relatively strong market. I think when you tally up the results in October, you're going to see the industry up versus last year and up versus October. And part of that has to do with the pent-up demand that you're seeing out there. But, the average selling prices are still at near record levels, although they're starting to come down. But, listen, when you have interest rates that are going up to the extent that you just showed on your screen there, I mean, in some cases, a car payment is approaching a rent payment in some parts of the country. Yes. And so I think you'll start to see a moderation in some demand falling off, maybe some more discounting.
Look at that. Average vehicle monthly payment, $700 in the third quarter? You got to be flipping my flapjacks. I saw a scary video suggested to me on, I think it was Instagram Reels the other day. And essentially, it was an individual going around like somewhere. I don't know where they were going around. They were asking everybody like what their vehicle payment was. And some people, it was like what you would expect from a vehicle payment for the most part, like, $200, $300, maybe $500. But some of these guys were saying like $1,500, $2,000, $1,200. I'm like, dude, if you got payments, if you go in $1,500 plus, you have like $1 million income. Like, if you make $100K a year and you're paying $1,500 to $2,000 a month in payment, what in the world is going on, man? What in the world is going on? No, okay? And if anybody's watching this, man, and you make $100K or less a year and your payment on your car is over $1,500, come on, man. We got to do better than that, man. We got to do better than that. I understand everybody has their vices and things they like to splurge on and things like that. But come on. That's a little extreme, okay? That's a little extreme. We got to either focus on maybe getting something a little more affordable or focus on getting our income up. That's all I'm going to say about that. Because you're talking about, especially if you're approaching $2,000, you better be balling out, man. You better have massive income and massive money in the bank. Because, I mean, we're just talking about, like $2,000 used to be like a mortgage payment. And now people are paying that on cars. Like I said, unless you're a baller, man, like that's just ridiculous. And when I say baller, I'm not talking about, $80K a year. I'm talking like you got to be making like $1 million a year to justify that sort of expense. That's insane, man. Absolutely insane. And this is downright scary. That's the average. Jeez.
As the inventory levels get back to other areas as we go in the months ahead. But right now, the dealers are fine.
Wow. 14% buyers are paying $1,000 plus a month. Oh my goodness.
Off a record 2 years, but I think they're prepared for tougher days, particularly going into 2023.
If you were still ahead of Ford, Mark, how would you view this time, and how would you view the wind down of certain businesses, for instance, and sort of getting lean into a potential recession?
Well, I think what you're seeing the automakers doing is they are starting to tighten their belts. First off, we have to put into perspective, Melissa, in the last 3 or 4 downturns, the industry has always been in a situation where there's been high discounting, high levels of inventory. You don't have that now. You have very low levels of inventory by historical standards. They have to restock.
He's 100% right as far as that goes. And I still go by a lot of dealerships, and I try to always look, if I ever go by a dealership, on like what's on their lot. And I definitely will say the used inventory has definitely gone up massively at dealerships in general, but new dealerships have increased a little bit from where I used to see it like 9 months ago, 12 months ago, especially like 18 months ago. But it still isn't. I still wouldn't say these dealerships are even close to being full like they usually were. Let's call it prior to Rona. Like, you used to be able to go by a dealership, right? And it was full of vehicles, new cars, used cars, everything. Like, it used to not even be a problem. Like, you want a new Suburban, you go buy, you got 20 different Suburbans to pick from, right? You want to go buy a new Land Rover, like there was a bunch of different Land Rovers you could pick from. And if you really want to customize, you could do that, right? You wanted a Toyota Corolla, brand new, like it wasn't a problem. And so it's been a weird dynamic over the past 2 years, that's for certain, in regards to cars. So they are going to have to catch up in terms of these dealerships and kind of fill from there. But I have also heard that some of these dealerships haven't minded this whole situation, because basically they've kind of gotten people on wait lists, and then a new vehicle comes in, and a lot of times they ask for prices over sticker. So, auto dealerships are always going to find their way to make money. Don't ever worry about those guys too much. They'll find their way to make money. They always do.
But that being said, when with these levels of interest rate, demand is going to fall off. 100%. So you're seeing automakers 100%. Announce reductions in workforces. You saw that happen at Ford. You saw that happen in other automakers, Stellantis, that are offering buyouts for employees. You're seeing them tighten their belts, like Ford deciding, listen, the investment in Argo AI, which was for level 4 autonomy, they probably don't see a path to profitability. So they said, listen, we're going to make choices. Strategy is about choices, and as you see tough times going forward. But the balance sheets of these automakers are in great shape. So I think they'll fare much better than they have in any other downturns. Of course, that depends on how severe it's going to be.
Mark, it's Karen Feinerman. Thanks for being on.
An important part you just mentioned there is, this is a former Ford CEO saying this, right? So I think he knows a thing or two about this. He says if interest rates remain high and go higher, like, it's going to hurt demand. And absolutely, any big purchase that's financed with debt, homes, cars, furniture, whatever it is, let's call it over $1,000, and especially if you're approaching over $10,000, that's a whole different level, right? All those things are going to get hit massively, worse than they've already started to get hit. And, that's just the bottom line. And that's going to be like that for like the next year.
You look at the industry and you think about the vast differential in valuation between a Tesla and between a GM and a Ford.
Let's not even go there. Come on, man. Just stop it. Do we really have to debate Tesla versus others' valuation? Come on.
Think about that. Do you think it's out of whack? And if so, from which sides?
Stop caring.
Well, I do think by any measures, Tesla is valued very, very richly. But listen, investors are looking at that, and they're looking at the growth prospects of the company going forward. When they come out and say, on average and over time, they're going to grow at 50%, that's pretty compelling. But, clearly, if you look at the valuation metrics, it is overvalued. But that being said, Elon Musk, there's a lot of star power there. He paints a very interesting picture for the future. But at the same time, I think the established automakers are making a lot of inroads, particularly on electrification. And I think at some point, the market is going to give them credit for that. But for now, they have not. And I think the other thing they're waiting to give them credit for is, listen, they have all said they're going to...
Why? This is important, okay? Why hasn't the market given any other real automakers any credit for what they're doing with EVs? Why has this happened? Well, remember, all these companies that are starting to sell EVs, from my understanding, every single one of them is losing a ton of money on every EV sold, okay? So if that's the situation, and these are investor bases that are really value investors, right? They're looking at these stocks as like, hey, it's a 5P, it's a 10P. They don't necessarily care about growth, so they're offsetting what they usually make a lot of profit with, ICE vehicles, to trying to sell these EVs that are, from my understanding, they're losing money on. For investors, these companies are like, what? And the growth investors aren't going to be attracted to a GM or a Ford. So they're in just a funky situation, a very strange situation, where their value investors are like, what are we doing? So we're going to lose money on a car instead of making money on a car? How does this make sense? And valuers of investors are like, dude, I don't care about GM or Ford. They're trying to move to the next wave. That's going to be difficult. And they're going to have to, try to make as much profit as they used to make on an ICE vehicle over here on EVs, and that's not an easy thing. We witnessed that with Tesla. Tesla went through a lot of stuff to get to their big profit days, right? And there's no telling if GM or Ford or Volkswagen or any of the other companies are ever going to be able to achieve that, right? So it's actually taking a big risk for investors, and that's why no one's giving them credit, even if they are starting to sell some EVs out there.
Have volume and manufacturing and pricing discipline through the next downturn. I think the market is going to wait to see if that happens, and if it does, then I think you're going to see some multiple expansion for the automakers, but not before that.
I'm going to ask you this question, Mark, because I've gotten some surprising answers when I've asked this question in the past of people who are closely tied, in the C-suite of various companies. But at this point in time, seeing that we are on the cusp of recession, rising interest rates, would now be a good time to be a buyer of Ford?
Well, I think it's always a good time to be a buyer of Ford. Of course, I'm a little biased.
You gave me the answer that I thought you would.
But listen, I think, investors should look at this from a historical standpoint. And when you look at the multiples of companies like Ford and GM today, they're quite low, but they are very differently positioned for this downturn. And so I think if the investors can look past the fact that we're going to have some demand destruction going on, the fact that the balance sheets are in very, very good shape, and the fact that, both automakers and all automakers are being quite transparent with the marketplace in the actions they're taking now to prepare them for that from a cost standpoint. I think long term, listen, autos are an important part of the economic landscape across the world, and I always think it's good to be invested in this space.
I presume you own Ford. Do you own other automakers?
I only own Ford.
Okay.
He's like, but I got calls on Tesla. No, could you imagine that?
All right. Mark, always great to speak with you. Thank you.
All right. Thanks, Melissa.
Mark Fields. I asked that because I asked Bill Simon, would you rather Walmart or Target? And he said Target. So I'm like, well, you never know what you're going to get back. You just should always ask.
Well, and we've gotten some interesting answers out of Bill, maybe for the other guy. But in terms of Ford, again, what is that multiple that he mentioned? It's 7 times on each side. So, I mean, it's attractive.
Yeah, when you look at the divergence between your traditional automakers and Tesla, as we mentioned before, and we've kind of had this conversation ad nauseum, you really start to look at those input costs. And with chips easing, you wonder, right now it's really, a battle of wills. Which one can raise prices higher and keep them there? And I think, you really need to look through at like the Greens Act and things of that nature that will kind of give us these incentives to continue to have the growth that all of these companies are banking on the EV space.
Yeah, so in terms of Ford specifically, right? Obviously, they've done a tremendous job over the years surviving. I would call it that. Sometimes they thrive, but a lot of times it's just surviving, and surviving as a stock, surviving as a company, and trying to get any valuation on the company, right? And many times it trades at P's of 5 and 10 and things like that, right? But in regards to Ford, remember that's a business that's very heavily reliant on the F-Series trucks. In terms of F-Series trucks, there's definitely some folks that buy those that don't necessarily use them for work. They just like to drive trucks, right? And so we're going to have to see what demand they potentially lose in 2023, 2024, and moving in future years, with obviously Rivian ramping up. And I'm starting to see more and more Rivians out here in Vegas, the pickup truck from Rivian, and obviously Cybertruck. So how much of a dent will that put in the F-Series trucks? I think that remains to be seen. I think in terms of people that use F-Series trucks for work-related stuff, I think that's going to continue to be in a decent place. The thing I'm worried about is I think construction is going to slow massively in 2023 and potentially even more in 2024. We'll see, okay? And so when I worry about that, I worry about F-Series truck sales, because if construction demand dies down in a massive way, the demand for F-Series trucks dies down in a massive way. If simultaneously you also have Rivian continue to ramp and you have Cybertruck hit in 2023, right? And then into 2024 in terms of mass ramp That's definitely something, is worrisome for Ford. And that's why a lot of people just can't buy that stock, man, just to be honest. Okay, AMD up next here. And by the way, if you didn't know, AMD bought out Xilinx over the past year, which was, in my opinion, ingenious acquisition.
It was kind of in line. They pretty much told us where the quarter was coming in, both on the overall financials as well as the segments themselves. The guide was up for debate, so we didn't know how long the PC weakness, both in terms of the market as well as the inventory correction that's going on, was going to continue. And I think more importantly, there's a lot of uncertainty about what they were going to say about data center, and particularly in the wake of Intel's report, where Intel had called for the market to decline in Q4. This is probably why the stock is up now. The guide itself is quite weak, but it seems likely that it's isolated to PCs and probably continuing on that inventory flush. The company suggests that both data center as well as embedded are actually going to grow sequentially as well as year over year, but importantly sequentially in Q4. I think that's what people want. They want to know that any weakness that's going on is strictly PC related, because we all know that market's not great right now. Data center seems to be holding in. That's probably why the stock's up.
And does that, relative relief in data center from what AMD said, is it specific to this company, or is that something that we can extrapolate?
I mean, clearly it's specific to AMD versus Intel. I mean, Intel's data center business, I mean, they actually beat the quarter because...
So he's got a $95 price target on AMD, so that's about, would it be about 50% upside from here, roughly, and an outperform rating on the stock.
PCs, surprisingly. Their data center results were horrendous, and they sort of suggested they were going to get worse into Q4. They suggested that the market, the TAM, was going to decline sequentially into Q4, and presumably Intel is still losing share in Q4. So their data center business trajectory was not set up very well. AMD...
I actually listened to the AMD call while I was in the bubble bath tonight, the replay of it. And something the analysts really, I call beat to death on that earnings call, was margins. They kept bringing up margins, and hey, you guys, in the second quarter we're at 54%, now you're talking about 52%, 50%, why is this? So they really were attacking margins. And I think there's kind of like two worries around AMD. One's obviously on the revenue side, because we don't know how weak PC is going to be. We don't know, how much strength or not strength is going to be in data center. And obviously with companies pulling back some CapEx, that affects that, right? And then there's margins. And so those are the two main concerns for AMD in the short term, right? Obviously AMD is a tremendous company long term that will thrive long term, but the market's not thinking about 5 years from now. The market's thinking about the next 6 months. And there's definitely, a lot of worries around margins and revenue when it comes to AMD over, the next 6 months. Let's put it that way.
Looks quite a bit better. That is the more important thing. Not to discount PCs. PCs are important. It's large, and it's got a fairly sizable haircut that AMD's taking right now. But the reason people are owning the stock is for data center, and at least for now, AMD looks decent, and it looks quite a bit better than what's going on with Intel.
I mean, the stock obviously had a very rough run, but it's just a matter.
These folks got to get better internet, man. Come on. Especially if you're analyzing a company like AMD. Like, come on, man. You got to get better internet.
Ramp off that mid-2000 level. It came right down to it, or in the high 50s. Now it's bounced from here. Valuation has obviously moderated quite a bit, if you can believe the earnings. How do you expect this to trade into next year?
How do you expect this to trade in the next year? How do you expect to be able to stream 4 games at one time on one 85-inch screen through Fubo TV? How do you expect to do that if your internet is weak sauce, sir? You got to step up your internet game, man. Fubo, 4 games at once, baby. That's what we don't. We could watch 4 space rockets take off at the same time on a Fubo, on an Apple TV. Oh, man, that'd be awesome.
Yeah, so let's see where the earnings settle out next year. We're right now around $4, and they're guiding below us in Q4. But it's probably hard to get numbers next year below maybe like mid-3s even, and the stock's at like maybe 17 times on a number like that. It's pretty attractive as long as you still believe in that longer-term growth story, which I think is still there. The issues that AMD's having right now, they're not structural, right? They're still taking share. Their product portfolio is really, really good. The issues that the markets that they're in, particularly PCs, the market sucks right now. That won't be true forever, hopefully. And the reason the markets that the people own the stock for, at least AMD's position within those markets seems to be good.
The main concern is data center, and obviously the PC business gets weaker before it gets stronger, right? What if we got 6 to 12 months more of weakness ahead, right? For long-term investors, you can kind of look past it. AMD in the 50s, 60s, buy, right? But obviously, Wall Street's very focused on these shorter-term numbers, and that's what they were thinking about.
And what about things like on the gaming side, whether for AMD or elsewhere, gaming purely speaking, or gaming as it relates to crypto?
Yeah, so crypto hopefully is done. And by the way, hopefully we never, ever have to worry about a crypto cycle ever again. Yeah. Now, for AMD, the GPUs, which...
We will. Don't worry. It will come back. Is it a year from now, 2 years from now, 3 years from now? That's for debate, but it's not going away, man. I'll tell you that much.
Is what you're talking about are actually a very small part of their revenue. It's less than 10% of their revenue anyways. It doesn't really matter that much. Most of their gaming segment is actually game consoles. Demand for those are still pretty strong. They've been very strong this year. The company has been suggesting that consoles can continue to grow next year. We'll see if they change their tune on that at all in this call. But in terms of like the crypto worries and the graphics cards, that's a small piece of the revenue. Now, they actually have an event. They've got new products in that market coming out. I think it's on November 3rd. They're going to be announcing new products. They actually have a data center event on November 10th that they're going to be. So we've got new product announcements coming across multiple segments for them.
All right.
In terms of, I think this is very important. I don't think a lot of people understand this. And this is in regards to NVIDIA and AMD. Because you hear a lot of folks say, crypto is not that big of a portion of their business. It's a smaller number or something like that, right? Which is fair. But you got to understand, when it comes to that market, what happens is a lot of folks in the crypto space buy AMD or NVIDIA products, which pushes demand overall, right? Which pushes prices because demand's higher. So companies like NVIDIA, companies like AMD that are thriving because of that, right, can get top dollar for their products. So that's the thing I don't think a lot of people think about. They think, it's only 5% of revenue last year, or 10%, or 7%, or 4%, or 12%, or whatever. And it's like, you realize that helped massive demand for their products, which made the gamers have to go pay top dollar for the products. And those companies say, we don't need a discount. We just got demand like that. We can sell full price, which is very, very different, right? And so I just think that's something important to keep in mind there. I am actually interested in AMD stock as potentially a 2023 buy. You're going to see me buy, I'll tell you guys this. You're going to see me buy a lot of large cap stocks in 2023. This year has been very, very focused on small caps up until basically very recently. But I think 2023, I think the way it's setting up, I think it's going to be a lot of large cap buys. We'll see what shakes out over the next 1 to 2 months. But I have a feeling Amazon, Meta, Google, AMD, maybe potentially NVIDIA as well if I want to play both. Maybe even Intel as well. I know it's crazy. I might even go that route as well in 2023. I wouldn't be surprised if I actually load the boat on a lot of large caps because a lot of them are in my opinion, probably going to continue to get hit, at least in the short term. And so don't be surprised if you see me buy a lot of large caps in 23. So anyways, guys, I appreciate you joining me as always. Much love. Man, I love doing this channel. I love these reactions. And I appreciate everybody that's joining me. 18,100 plus subscribers strong at this point in time. Strong like Donkey Kong, as they say. And if you ever want to say hello to me, say hello on Instagram, Financial Education Jeremy. Don't follow the fake accounts, okay? There's people try to change up the characters or whatever and try to impersonate me all the time and try to get Ethereum and Bitcoin and whatever other cryptos out there. So make sure you don't follow those. Follow the real deal, Holyfield. Much love as always, and have a great day.